This is Nightly Business Report with Sue Herrera and Bill Griffin.
Monday blues. Stocks dipped to start the week amid the longest bull market on record, but there are signs that equities may be able to keep on climbing.
Save the date. December 15th is fast approaching, and it has big implications for our economic relationship with China, as well as Canada and Mexico.
Behind the wheel, the discounts are deep, the savings look big, but a closer look shows the numbers might not be what they seem. Those stories and much more tonight on Nightly Business Report for Monday, December 9th.
Good evening, everyone, and welcome. Caution reigned on Wall Street. Investors hit the pause button following a sharp rally Friday, falling for the first time in 4 sessions. The market shifted its attention from the strong jobs report Friday to looming trade deadlines, which we'll have more on in just a minute. And that was enough to send stocks lower. The Dow Jones Industrial Average dropped 105 points to 27,909. The Nasdaq was down 34, and the S&P 500 slipped 9. Today's pullback comes amidst the longest economic expansion in history, and many are wondering what happens to the aging bull market as we head into 2020. Here's Mike Santoli.
More than a decade into the longest expansion in history, even Wall Street's optimists accept that the U.S. is in a pretty late stage of the economic cycle. Yet even before Friday's surprisingly strong jobs report, there have been signs that this expansion could be more durable than its age implies. The pace of growth since the Great Recession has been relatively plodding by historical standards, which has kept big parts of the economy on separate tracks, running at different speeds. Some broad indicators certainly appear to reflect late cycle conditions. Unemployment at 3.5% can hardly improve too much. Consumer confidence peaked recently at lofty levels. Corporate debt is at a record, and auto sales crested a few years ago. Still, the housing market was slow to recover from the 2008 bust and is now benefiting from strong supply-demand dynamics with plenty of ground to make up. Consumer debt burdens are also quite tame, unlike the usual situation at the end of an economic expansion. And the stock market, while it has more than quadrupled in value since the 2009 low, has undergone 3 mini-cycles. Slowdown scares starting in 2011, 2015, and late last year drove nasty 15 to 20% drops in the S&P 500, leading to no net progress for more than a year before stocks resumed their rise. This has helped keep valuation and speculative excesses from building up to dangerous degrees so far. And in recent months, sectors geared to a pickup in economic growth, such as industrial stocks and banks, have begun performing better, suggesting investors are gaining confidence in the growth outlook. Now, none of this means the economy is in the clear for years to come, or that a shock from the trade war or elsewhere would be easily absorbed. But the evidence suggests that even if this is a mature cycle, it can plod along for quite a while before a recession ultimately arrives. For Nightly Business Report, I'm Mike Santoli.
But interestingly, despite the market's big run, individual investors have been dumping stocks at the fastest pace in decades. According to the Wall Street Journal, which cited data from Refinitiv Lipper, investors have pulled $135 billion from U.S. stock-focused mutual funds and ETFs so far this year. What to make of that? Joining us right now is Art Hogan. He's the chief market strategist at National Securities. Welcome back, Arthur. Good to see you.
Hey, Bill. Thanks so much. Good to see you.
Tradition on Wall Street says that when the market is near all-time highs, that's when the small investor is piling into the stock market. But they're getting out right now. What do you make of that?
Yeah, interesting. A lot of macro news that has the investor kind of concerned. So, ongoing U.S.-China trade war, the potential for a nasty little Brexit after 3 years of going back and forth on that. But certainly that muscle memory for the fourth quarter looked like last year. So if you're an investor and you rode last year's 17% drawdown in the S&P 500 in the fourth quarter, most of that happening in December, you say to yourself, hey, listen, we've had a great year. Why not take something off the table? The other thing that's really important here, too, Bill, is the demographics. That the aging baby boomers is going to be moving out of equities, whereas that next generation coming up, it just hasn't started building up enough wealth to make up for that. So you understand you've got the aging baby boomer generation that's starting to cash out of stocks and put things more in the fixed income world.
You say that there are 3 things, though, that make this December very different from last December.
Yeah, thank God, right, Sue?
Yes.
Right. So last December, the Fed, at this meeting that we're having this week, raised rates and talked about raising rates 3 more times the following year, 2019. Now we have a Fed that's cut rates 3 times and stand at the ready. So they're neutral right now, but they stand at the ready. The second thing is the economic data stream last year. The global economy was slowing. The U.S. economic data was following that. So both of those things much different on a year-over-year basis. But I think the largest thing is the tone around U.S.-China trade is much more constructive this year. We're getting closer to a phase 1 deal. Last year we were miles apart in what we wanted to do. So I think it's trade, it's the Fed, and it's certainly the data.
This demographic play is interesting. There's no reason to believe that the boomers won't continue to take money out of the market as they age and get ready for retirement. But what does that do for the market overall in the long run?
Well, that's a great question. So when we look at this, and the problem with the boomers in general over the last 10 years is that there was no place for them to go to get yield, that TINA was really in place. So they were forced out on the risk scale much longer than they should have been. That manifested itself in overinvestment in the bond surrogate. So we saw staples and REITs and utilities trading at historic high multiples in terms of where they should be. So you're seeing boomers actually chase yield where they can get it, and they're finding that in places that are now getting expensive. I think that's the most dangerous part of this. But when there's a large population of people getting out of the market and the group behind it is slow to pick that up, you depend on global demand, and U.S. equities are probably the best place to be in the global equity markets.
Art Hogan with National Securities. Thanks for joining us, Art.
December 15th, just around the corner. That is the day that new tariffs on Chinese goods are set to take effect if the U.S. doesn't make additional progress with talks with Beijing. Here's Eunice Yoon.
The December 15th tariff deadline is just days away, and it's just as uncertain as ever if the two sides will be able to negotiate a deal in time to avoid fresh tariffs. That would be bad news for manufacturers here, which suffered in November. Exports missed. Imports improved, but on demand for agricultural products, other imports remain sluggish, leading analysts to stay cautious about the economic outlook. Another development that could spell trouble for U.S.-China ties, the Financial Times is reporting that Beijing has ordered all government offices and public institutions to remove their foreign PCs and software within 3 years. Dubbed 352, the policy is meant to replace 30% of foreign tech in 2020, 50% in 2021, and the remaining 20% the following year. U.S. tech giants like Dell, HP, and Microsoft stand to lose. The move comes amid concerns of a tech decoupling. But it's unclear how quickly that could happen, since much of the Chinese gear meant to replace the U.S. equipment relies on American parts, and Chinese software still lags behind the U.S. For Nightly Business Report, I'm Eunice Yoon in Beijing.
Now, December 15 could also prove to be a critical date for another deal, the new NAFTA. Kayla Tausche has that part of the story in Washington.
More than a year after the United States, Mexico, and Canada signed the replacement for NAFTA, the USMCA, the deal is getting closer to ratification. Protracted negotiations between the White House and House Democrats over the agreement's labor and enforcement terms are nearing a tentative deal. Here's President Trump today.
I'm hearing very good things. I'm hearing from unions and others that it's looking good, and I'm hearing a lot of strides have been made over the last 24 hours.
After the two sides reach a deal that Canada and Mexico would back, the White House must send the official text to Capitol Hill. If that happens by December 15th, the White House has told allies expect the House to vote on it on December 18th, one day after a potential vote on impeachment, though all dates are subject to final scheduling by Speaker Nancy Pelosi. Two senior Democratic aides say lawmakers are still studying the White House's final proposal, but note a deal is very close and could be announced within a day. For Nightly Business Report, I'm Kayla Tausche in Washington.
It is time to take a look at some of today's upgrades and downgrades. Macy's was downgraded to sell from neutral at Goldman Sachs. The analyst cites the recent deterioration in fundamentals and sees significant additional downside to the retailer's operations. The price target is $12. The stock rose, though, 2% to $15.48. 3M was downgraded to neutral from buy over its Citi. The analyst cites the 2018 peak in industrial production and a mild downturn in the sector. The price target is $180. The shares fell about 1% to $169.83. Qorvo and Skyworks Solutions were both upgraded to buy from underperform at Bank of America Merrill Lynch. The analyst cites the anticipated increase in demand for chips due to the growth of 5G technology. Qorvo's price target is $130. Skyworks' price target is $122. Both stocks rose more than 1.5% in today's trading session.
As you likely know by now, Paul Volcker passed away over the weekend at age 92. He was a prominent fixture in the world of finance for more than 40 years. He served 6 presidents in various capacities, most famously as the chair of the Federal Reserve in the 1980s. Well, the current Fed chair, Jerome Powell, and his colleagues today are dealing with a low inflation environment. And in some ways, they can thank Paul Volcker for that. He is credited with taming runaway inflation in the 1980s, but earning that credit wasn't easy. Paul Volcker was president of the Federal Reserve Bank of New York when President Carter asked him to become chairman of the Federal Reserve in August of 1979. At that time, economic growth was way down, but prices were way up, putting the economy in a period known as stagflation. By the spring of 1980, GDP was down to 3%, and inflation was up to 14%. Ronald Reagan was elected president in November of 1980, and he vowed to get the economy growing again. But Volcker, who committed to stopping inflation by keeping the money supply tight and interest rates high, found himself at odds with the president for years.
Nobody in the Federal Reserve, certainly not myself, likes high interest rates. They're no fun.
And they weren't. The Fed funds rate reached as high as 20%. 6-month bank CDs were paying more than 13%. Construction slowed. Farmers were reluctant to plant. And even though rates began to fall in 1982, unemployment peaked at just below 11%. Everyone from the administration to Congress pointed fingers at Volcker. But he stuck to his plan, and by 1984, inflation had plummeted to 4%.
It's never very pleasant, I suppose, to tell someone that some pain in the short run is good for the long run.
Then in 2008, President Obama consulted Volcker during his presidential campaign. He later appointed him to chair the president's Economic Recovery Advisory Board. Volcker backed the idea of breaking up large banks and banning them from speculative trading activities, a plan that came to be known as the Volcker Rule. It, too, was unpopular in many circles, but it helped restore confidence in the wake of the financial crisis. Just the role Volcker deemed crucial as the Fed celebrated its 100th anniversary in 2013.
Predict it or not, those economic and financial disturbances demanded a response. And the point that we, I think, celebrate in part today is a response, demanded a response that only an institution equipped with authority and judgment could timely act upon. You know, in any country, that role falls importantly to its central bank.
The great inflation fighter, Paul Volcker.
In a lawsuit unsealed today, Amazon said the Pentagon's recent decision to award Microsoft a cloud computing contract should be revisited. Amazon cites, quote, substantial and pervasive errors, and that President Trump's improper pressure harmed its chances of winning the $10 billion deal. The Pentagon says the decision was made by a team of career public servants without external influence.
Some of the biggest mutual funds have invested billions of dollars in technology startups, all in an effort to beat their respective benchmarks. But the strategy may have also added more risk than necessary to some widely owned portfolios. Deirdre Bosa has more.
Unicorns aren't just for venture capitalists anymore. Increasingly, some of the most valuable startups, those worth more than $1 billion, have been getting funding from some of the biggest mutual funds. They're money managers that are well versed in public markets, but less so in the highly illiquid, less transparent private markets.
So these mutual funds perhaps have an incentive to want to come into those private rounds earlier where they can get their allocations on the books, even though they may be pushing the price a bit.
But this year, as some of them have flopped, mutual funds got burned too. According to data from PitchBook, the top 10 mutual funds collectively held WeWork shares worth nearly $600 million in the first half of the year. Fidelity, Vanguard, and Jackson National placed lofty valuations on their holdings of WeWork, only to have to mark them down as much as 75% after the company's botched IPO attempt. Another unicorn flop was Juul, once valued at $38 billion in the private market. Fidelity and American funds had to mark down their holdings by nearly half after its value was slashed in the private market. Ride-sharing is another area that has drawn the interest of mutual funds. T. Rowe, Fidelity, and Vanguard were pre-IPO investors in Uber and Lyft. As public companies, their shares have struggled. Question now is, do some of these high-profile markdowns make mutual funds reconsider their unicorn strategies?
I mean, it's already pulling back, right? If you're a mutual fund investor and you see these markdowns, right? They're seeing markdowns in the public market too, certainly in some of their holdings. But if you see these markdowns, it's only natural that you're going to pull back your risk appetite a bit.
Next year's big market debut is expected to come from Airbnb, another name that has drawn funding from major mutual funds. It could also be another test for the appetite of institutional investors in high-flying unicorns. For Nightly Business Report, Deirdre Boza, San Francisco.
Nancy Tengler joins us now to talk more about mutual funds and the sometimes risky bets that some have made investing in big technology startups. She is Chief Investment Officer with Tengler Investments. Welcome back, Nancy. Nice to see you again.
Thank you, Sue.
And you are not a fan of this strategy at all.
No, I think we've seen two things that can come from this. First of all, this is not the expertise of fund managers. What we do is analyze publicly traded companies with a track record of public accounting and meeting quarterly earnings objectives. And they're judged harshly for that. There's so much capital chasing these unicorns in the pre-IPO market that we've seen the encouragement of excess in spending, lack of discipline in managing the business. WeWork is one example, but there are others. And so I don't think that these companies or these mutual funds that have built their track records on publicly traded companies should be, in fact, investing at pre-public companies.
But you have to admit, this may be the only opportunity that some individual investors, if they invest in these funds, this gives them the opportunity to participate in a market that that is pretty much out of their reach otherwise, right?
I think that's right, Bill, except we're both making the assumption, and oftentimes it is the right assumption, but not always, that IPOs are a great place for retail investors. If you just go back and look at Snap or Facebook, the early years of these companies coming public have not been their best years. In fact, Snap's gone down, Facebook went sideways for about 2.5, 3 years. So sometimes missing out on that initial IPO pop is not necessarily a bad thing. Now, because I think there's plenty of money to be made later. Right. So I can argue both sides, but I think it's the pre-IPO that I most object to, that investment by mutual fund managers.
We have seen a lot of IPOs recently, certainly, Nancy. What does that tell you about the overall market?
Well, I actually think that the flop of many of these IPOs is good news for the market, because what we, for the sustainability of the bull market, what we often see is a blow off right at the time when all these IPOs were offered in the late 90s. That was an indication that we were at a market top. They soared no matter what they did. Many of them were just Amazon lookalikes that weren't Amazon. So I think the fact that investors are being discriminating is a good thing for those of us who would like to see this bull market extend.
Before we let you go, we're all remembering Paul Volcker today and his impact on the financial markets. What are your thoughts on the great inflation fighter?
Oh, Bill, that was an outstanding report. I mean, for those of us that lived it, I hadn't thought about his influence and impact until today, and I was so saddened. I mean, those were difficult times. We had a misery index that was in the high teens, and It was difficult. We needed somebody with a spine of steel, and he was there despite the unpopularity and despite the fact that Reagan's administration demanded that he lower rates. We thought President Trump invented that, but indeed it's been going on for a long time. He stood his ground, and aren't we grateful he did?
Indeed. Nancy Tangler with Tangler Investments. Thanks, Nancy, as always.
Thank you.
Merck pays billions of dollars for a biotech. That's where we begin tonight's market focus with the drug maker buying Arcule for $2.7 billion. Merck says that the deal is going to expand its cancer treatment offerings beyond its own immunotherapy drug Keytruda, which itself booked $3 billion in sales in the third quarter. Shares of Arcule more than doubled to $19.71. Merck was down a fraction to $88.72. And fellow drug maker Sanofi is also sharpening its focus on cancer treatments with the acquisition of Synthorx for $2.5 billion. Synthorx is developing a drug that aims to boost the immune system's response to cancer. The drug is in the early stages of testing on a range of cancers. That deal sent that stock up 170% to 67.71. Sanofi was down more than 1% to 45.30. And Canopy Growth has a new CEO. The cannabis producer named Constellation Brands CFO as its new chief executive. Constellation is Canopy's largest shareholder. It has a 38% stake. Stock rose 14% today to $21.29.
Morgan Stanley is reportedly cutting about 2% of its workforce due to an uncertain global economic outlook. According to CNBC, the job cuts will come from technology and operations roles. The bank has approximately 60,000 employees. The stock fell a fraction to $49.60. And Toll Brothers reported better than expected earnings and revenue, helped by a rise in confidence and lower mortgage rates. But the home builder also reported a 35% drop in profit from a year ago, hit by lower margins from home sales. Shares were volatile in initial after-hours trading. They closed the regular session up 1% to $41.42.
Can anything get in Disney's way at the box office these days? Frozen 2 was once again the top weekend movie for the third straight week. But as that movie looks to break more records, another new release was an outright flop. Julia Borston has more on the box office haves and have-nots.
Here you are, enjoy.
A big winner and a big loser at the box office this weekend. The winner, Disney, eclipsing its own record, becoming the first studio in history to top $10 billion at the worldwide box office.
Part of the journey is the end.
Disney had 6 of the 10 biggest movies of the year. This record number was fueled by Disney's Avengers franchise, Lion King, and most recently Frozen 2, which has grossed $920 million worldwide in just 2 weeks. At the other end of the spectrum, a record flop from Playmobil, the movie from STX. The animated film was distributed to over 2,000 locations, but brought in less than $670,000 in ticket sales. That's the third lowest debut ever for a film playing in over 2,000 locations. One reason for that low revenue number, theater chains offered tickets for $5, a meaningful discount from the average U.S. ticket price of over $9. STX, a newer studio, had hoped that lower ticket prices would help drive attendance, but the film suffered from weak reviews, a mere 18% positive rating from critics, according to Rotten Tomatoes. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Coming up, deals on new cars are everywhere, but don't let some of those deep discounts fool you.
You have probably seen all of those end-of-year sale signs at auto dealers, complete with balloons and the big red bows. It has become the biggest sales season of the year for that industry. But even though there are plenty of seemingly tantalizing offers, are they good deals? Phil LeBeau takes a look at the rising number of discounts along with the rising price of cars.
Call it the MSRP fakeout. That new car or truck you're looking at comes with a huge discount. It looks like the greatest deal ever. Well, think again.
When you have an expensive vehicle and you could advertise 20% off or $15,000 off, I think to a lot of people that signifies a really great deal. Could it have better in the past? Perhaps it could have been, but I think that a clear message that is compelling with a high dollar amount will at least pique people's interest.
Who can blame buyers for being interested with some discounts topping $15,000? But look closely at the sticker prices, and you'll see they are also going up, way up. Since 2010, they've jumped 25% to almost $40,000. Not surprisingly, the price buyers pay for new models like the Ram 1500 have also soared. 9 years ago, the average Ram pickup sold for $36 grand. Today, the average price tops $53 grand. And it's not just Ram. Prices have soared on virtually every new model. And experts believe we will continue to see new car prices climb.
I think for automakers, we'll continue to see the MSRP move up, especially as they add more content, because I think that's a natural occurrence, especially as the model years go, continue, the vehicles get more expensive. That is naturally going to go up.
All of that means auto loans are also getting bigger. So is the average monthly loan payment, now at a record high.
So when you see an automaker offer 15 or even 20% off of the sticker price, is it a good deal? Sure, thousands off of any new vehicle is attractive. But in terms of it being a percentage of the price ultimately paid, well, it's not going to be much different than it was just a few years ago. Phil LeBeau, Nightly Business Report, Chicago.
And before we go, here's another look at the day's final numbers on Wall Street. The Dow dropped 105 points to 27,909. NASDAQ down 34. S&P 500 slipped 9. And that is Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. See you tomorrow.